So if your portfolio is anything like mine, over the past month, it's taken a pretty big hit. Here's ISA 1 over the past month. Here's ISA 2 over the past month. And then here is my self-invested personal pension over the past month. So in total, my investment portfolios are down by about £5,000. And I just wanted to do a very quick video to go over the reasons why, what I'm personally doing, and the few things to be careful of. I think it's important to make videos like this because if you're a new investor and this is your first market dip, correction, crash, whatever this turns out to be, it's important to know that this is part and parcel of investing. And if you approach investing with the right mindset, the long-term mindset, and you did appropriate research before getting started, then you'll know this is nothing to worry about. But let's get into it. So I decided to wear red for this video. I thought it'd be quite appropriate. As you can see on the S&P 500 chart, it is down by quite a significant amount over the past month. But importantly, I've also put the Vanguard S&P 500, which is one of the most popular ETFs for UK investors to invest in the S&P 500, along with the GBP to USD exchange rate. And I wanted to show this because it shows that UK investors have been hit harder than just standard American investors in the S&P 500. And that's because the pound has strengthened against the dollar. And what you've got to remember is when you're investing in the Vanguard S&P 500 or any other S&P 500 ETF that is listed in GBP that isn't hedged, the performance of your investments isn't just reliant on the underlying stocks because you're buying that fund listed in pounds, but all the underlying stocks are in dollars. Those dollar listed assets, when converted back into pounds, now get less pounds because the pound is stronger. I hope that makes sense. And also, I'll put this FinViz chart on. This is a couple of days ago I took this screenshot. And we've had a few days like this in a row where we've had very red days, but I think this FinViz chart really shows where that dip is concentrated. It's mainly in the tech sector. Those Magnificent Seven companies have taken a big hit. And because they are such a large part of the overall S&P 500, this in turn leads to a big hit for most investors' portfolios. Okay, so onto the why is it dipping by so much? Well, firstly, you probably can't escape the news that Trump is imposing a lot of tariffs on Canada, Mexico, China, and now I'm pretty sure global on aluminium and steel. And tariffs just quite simply aren't good for the stock market. They lead to prices increasing. This in turn reduces demand. But also what's happening now creates a lot of uncertainty. It seems every day there's a new tariff or he's withdrawn a tariff, he's putting a tariff back on. No one knows what's going to happen, including everyone participating in the stock market. And the stock market hates uncertainty. The second major reason for this dip is Trump failing to rule out recession and signs of consumer spending lagging, so maybe a recession is on the horizon. And then lastly, valuation. The S&P 500 and US stocks were very expensive. You can't escape it. I always refer to Yardeni research because it's a great way to get up-to-date forward price to earnings of the S&P 500. And you can see even with this recent dip, the S&P 500 is very expensive compared to its recent history. And when stocks trade at such a valuation, there needs to be constant good news to justify that valuation. Not just okay news, it has to be good news to justify such valuation. And recently we've had bad news, uncertainty, so it's unsurprising the stock market has reacted the way it has. You need that constant good news, that constant reassurance to justify these valuations. That's the reasons. They may sound scary, a lot of uncertainty, a lot of negative press. But at the end of the day, it doesn't really change my strategy. And I've got a long-term mindset when it comes to investing. And let's now go into that reason why maybe a long-term mindset is better for you. Now, to be clear, I'm not a financial advisor. This is not investment advice. Feel free to do with your investments whatever you want to do. I just want to put my take on things and run through a few points I think are important for investors to realize and to consider during times like this. Now, the first point is hearing a lot of people saying this time it is different. I've had people commenting on my posts saying that this is the next Great Depression, Wall Street crash. It's going to take 10 to 26 years to recover. And who knows, maybe that is the case, but it is incredibly unlikely. So there's a lot of these different charts that show you the history of the S&P 500 and all the events along the way. I'll put one on screen now. I don't know which one it is. I'll decide it in the editing. There's loads of similar ones. But the point is, regardless of how many bad things that have happened, the S&P 500 has always recovered and gone up. The long-term track record is going up. Now, past performance does not guarantee future results, but it does act as some sort of reassurance that negative events are part and parcel of your journey when investing. Bad things happen in the world. Negative things happen to the economy. And this is going to lead to volatility. The stock market doesn't go like this upwards, otherwise everyone would invest into it. And in fact, there wouldn't even be good returns if that was the case. Volatility is part and parcel of investing. You're getting that equity risk premium, that return above the risk-free rate because you're taking on that market risk. So for those saying this time it's different, I'd love to know where they've bought their crystal ball and why is this time different? Why is this time so much worse than all the other events we've had in the past 20, 30, 40, 50, even 100 years? The next thing I wanted to cover was panic selling. So when you see your portfolio going down, and as you can see, I was fully transparent at the start, my portfolio is down by nearly 5k over the past month. It can be quite scary, especially if you've never seen it before, and you feel like you're losing money every day, and you need to get out to reserve the capital you have remaining. And that may sound like a smart thing to do, but I'd just take a step backwards and think when you got into investing, you probably heard a lot of people telling you it's for the long term, you don't touch this money for 5 to 10 years, if not even longer. So why now, when markets are starting to go down, are you now thinking to take it out? It's a bit too soon to forget your mindset that you went into investing with. And it's true, it's different when it actually happens. It's all good people saying, oh, think long term, zoom out and look at the bigger picture. But when it actually happens to your portfolio, your money, and you're seeing those red numbers, I completely understand it is scary. But what I'd personally say is just try and return to that mindset you went into investing with. The bigger problem with panic selling, though, is when are you going to get back in? When do you know the market has stopped dipping? When are you going to rebuy? There's no bell being rung at the bottom of the market saying, now get back in, it's the bottom now, you can now invest safely again. No, the market is never going to tell you that. And when it recovers, the recovery can be very quickly. Before you know it, the dip's gone. Markets can recover very quickly, sometimes even quicker than they crash. So me personally, I just keep all my investments in there, top up regularly, do my regular investments, any planned lump sums I have, just put them in. Don't pay any attention to what the market is doing. I have no idea. What's more important to me is just keeping up those consistent contributions. Some months I'm going to get better prices on my contributions, other months maybe slightly worse prices. So yeah, sum up panic selling. The key problem here is reinvestment risk. How are you going to know when to get back in? My third point is, if this sort of stuff really scares you, then it's probably worth looking into automating investing. The sort of investing where you set up a savings plan or direct debit or regular contributions, whatever your platform calls it, and then your portfolio is topped up every month. It's like another part of your monthly bills, and you don't even have to log in to check. It's like how some people don't like to read the news because it gets them down or depresses them. Well, you don't need to look at your portfolio if you don't want to. Just automate it, set those regular contributions, maybe check in once a year, just see how things are going. But if it makes you panic to see these things, then maybe just don't look at all. Also, maybe take another look at your risk appetite. Are you really the sort of person that should be 100% in equities? Should you go into other things? Or maybe you do actually need and will benefit from a financial advisor that will take care of these things for you. Okay, point 4 is kind of the opposite of point 2. Rather than panic selling, it's now like panic buying the dip. You hear this all the time whenever the markets go down slightly, buying the dip. And whilst I personally think this is better than panic selling, I do want to caution against the so-called buying the dip, because the dip can always dip further. As we've seen over the past month, people were saying buy the dip when it was down by 2%. The Vanguard S&P 500 ETFs are now down by over 10%. I'd be very careful to not dip into your emergency fund using your short-term savings to buy the dip, because it is a form of FOMO investing. It can always dip further, and then you're going to be worrying about, oh, I should have waited a bit longer, and you'll be questioning yourself. There's no point questioning yourself because you probably couldn't have timed it any better, because no one can time the market perfectly. And whilst I may joke in my Discord every now and then about buying the dip, it's just because it's part of like the investing mindset, buying the dip. Being sensible, I know I can't time the market, and buying the dip is a form of timing the market. Moving on, another point regarding buying the dip is applying this buying the dip philosophy to individual stocks. When people talk about buying the dip or getting a cheaper price into the market, they're talking about the market as a whole, an index fund like the S&P 500, a global fund. This should not be applied to individual stocks. I frequently see people increasingly on my YouTube homepage that are all in on individual stocks, and they're applying this buy the dip mentality or DCA mentality to individual stocks. Yes, historically the market has always recovered. This does not apply to individual stocks. Individual stocks can and will go down and never recover. If we have to give the disclaimer that the market as a whole may never recover, this 100% has to be said when talking about individual stocks. So, and just be careful you don't get stung with buying into a falling knife that will never recover. And the last point I want to make, hopefully this video is not too rambly, is regarding experts coming out with technical indicators, telling you to look at stuff like the monthly MACD, timing the market, using these indicators, oh, it's crossed the signal line, time to sell out, go to cash. And whilst there may be some merit to this, I think the general thing to consider for long-term investing is that using technical indicators to time your entry and exit, these things have lag. They're not perfect. If it was that easy, you just needed to wait for something to cross the signal line to get in and out of the market. Well, wow, honestly, how come these active managers don't perform so much better than they do? Every active manager should be able to outperform the market if it was just as simple as looking at the monthly MACD. But maybe that's just something that gets on my nerves. I just wanted to quickly get that out there because if I hear about the monthly MACD one more time, I'm going to scream. Anyway, thank you for watching. I'll put up all my portfolios on screen again now just to show you're not alone. My portfolios are tanked too. It's part and parcel of investing. I knew what I was getting in for. There's a reason why I put all these disclaimers on my videos, because investing does carry risk. It's not for the short term. It's meant for the long term. Past performance does not guarantee future results. Your capital is at risk. Just make sure you have the right mindset. Don't make any rash decisions. And be careful on social media at the moment. There'll be a lot of experts that may influence your decision making. Just be sensible. If you enjoyed this video, be sure to leave a like. And please do let me know your thoughts in the comments below. I'd love to hear. And as always, thank you for watching.